Hey, listeners, welcome back to the ValueHunt podcast. And today I'm really excited to be here with Shawn, CEO of BuildDirect.com. And today we'll dive into BuildDirect, what they do, what they don't, and ask some thought provoking questions and see what Shawn has for us. So, yeah, Shawn, why don't you say a couple of words and maybe explain in a very simple way what BuildDirect does for those coming across BuildDirect for the first time?
Yeah, so BuildDirect is focused on the North America flooring industry. There are some adjacent categories for the future. We're primarily a consolidator in this space with the focus on the professional customer, which I'm sure we'll get into a bit more later what that's all about. So it's initially around $90 billion TAM, which will continue to expand, and it's a great industry to be part of.
Okay, perfect. So let's jump into the first question from the audience. And it says BuildDirect reported Q3 2024 revenue of 70 million and adjusted EBITDA of zero point 0.8 million. While these figures show progress, they also highlight relatively thin margins. What specific steps are you taking to improve profitability, and how do you plan to scale revenue while maintaining cost discipline?
Sure. So I would say, there's really three buckets from an operating perspective that we've been working through over the past 2 years, and really making a lot of progress here on them. Kind of first and foremost has been the e-commerce business, which we talked about quite a bit. We've changed that model. We've changed how we do order fulfillment from third-party warehouses to using our Pro Center network, also marketing. Uh, geofencing tighter on delivery areas based on our brick and mortar footprint. So I'd say, just overall that work took a bit to work through and has gone very well, and it's a great business that that's contributing pretty healthy returns now. So I think that's a good kind of good place to start first. Second, I would say on the corporate cost side. So I came to the company about 2.5 years ago, and we restructured quite a bit with the last main piece, which we announced here a few weeks back on the not just a cost reduction from like a eliminating excess costs, of course, but rather focusing the corporate platform on just the intrinsic needs of what that needs to be, and deploying resources in our operating divisions. And so I would say on the margin side, that will continue to improve really from those two things. On our brick and mortar business, that business has great EBITDA, and has been effectively offset from the first two categories. And so I would say the discipline we've had around getting e-commerce into a good position, as well as on the corp side, having very clear guardrails as to what we want to provide from a corporate like functions perspective, has been very, very key and important for us.
Mm, perfect. Okay. So, next question is, can you provide more clarity on the drivers behind the Q3 2024 performance? Were there any one-time factors, or is this growth indicative of a sustainable trend?
No, I would say the from a one-time factor perspective, no. We're pretty cautious around that. And yes, the growth improvement is something that you can continue to see, especially moving into what we've announced more recently regarding some activity on the M&A side, how it was structured, as well as the debt facility we put in place with RBC, and also really getting a very lean operating platform on the corp side. So I'd say, yeah, continued improvement is definitely a way to look at it.
Okay, perfect. Next one is a very long one, so I'll keep it short. How do you plan to balance how do you plan to balance debt reduction with the need to invest in growth initiatives?
Yeah, it's a great question. So I'll kind of say first and foremost, the when you look at the legacy debt that the company incurred, yeah, a big part of that first was really stemming from an e-commerce business that was not doing well for many years. It was really a drag on our financials, and so With that stated, wanting to get to a point where we can more responsibly grow out of debt was a kind of a key thing for me. Not being too premature with any solutions there. I value the company at candidly a much higher level. From an industry perspective, it's a great business, and so for us, a big part of that, the debt's friendly. It's from our insiders. It's payment in kind, and there's patience there to make sure we're able to grow out. Not saying that'll be how the it's it's resolved one way or another, but for the most part, that was an important part for me coming into the company a few years ago and working through the challenges. Was that, and that's also been can be seen by how the insiders, including our management team, has interacted and what we've kind of prioritized along the way.
Okay, perfect. I have to jump in because this is not in the questions from the audience, but I'm really interested in knowing what kind of motivated you to accept the role of CEO at BuildDirect, because I guess it was a pretty troubled company and it's not the most attractive job proposition from outside. I guess I don't know. Maybe you can put some color on that.
Yeah, no, absolutely. It's interesting when I came across BuildDirect, kind of going back a bit, I've been in the flooring industry for over 20 years, and encountered BuildDirect years ago while I was at Mohawk Industries, which is um, one of the largest flooring manufacturers in the world, and it was a vendor for BuildDirect. And it was interesting, many years later, coming across the business. It was still around. It had kind of an interesting past. But what I saw was what it had. When I look at businesses, whether it's this one or in the past or what we're looking at doing on the growth side, um, just candidly, I don't pay a lot of attention to what people say things are. I look at what they are, what the pieces are, what the components are. And
Hmm.
BuildDirect had some interesting facets. One, it had an e-commerce business that had a lot of challenges, but they weren't complicated. They were on the fulfillment side, which we're able to resolve at a very aggressive direct sourcing program, whereas other companies that worked for and with had multi-layer sourcing. They might say they buy
Hmm.
direct, but they really didn't. They had agents and distribution in between. But then also the company had already had a foothold in brick and mortar on the pro side, and those two things worked together beautifully. And so it was my opinion, a fantastic company to come in, get retooled, and then to use as a consolidating vehicle in this space. There's one last piece. I don't talk about it very often. It's like I really try to stay focused on what we're doing, but um, BuildDirect's Pro, which was really cultivated over many years, very hard to replicate. 20 years of demand gen and market activity, was not a flooring only customer. They were subcontractors who, maybe one day did flooring, the next day did crown molding, and the next day did cabinetry, things like that. And so intuitively, there was the customer base could be very ripe in the future for adjacent expansion. You don't find that in a lot of businesses. Effectively, all these pieces that could be reconfigured into what we've really geared the company to at this point. And I guess I'll probably end with the flooring industry is highly fragmented, and so if you are north of 50 million, US in revenue, you're in the top list of funny enough, top list of competitors in the category. So it already has scale when it comes to procurement, um, marketing, kind of things like that. So effectively, yeah, just taking an objective look at what was there, the team that was in place, and the challenges they had, and then bringing in the right resources to solve those problems, reconfigure, and get moving was a massive opportunity. And candidly, I feel very grateful for the opportunity. When I was going through it, kind of initially, I felt like I discovered a treasure that just was being that was buried. And it was a
Yeah.
lot of fun to unbury it, dust it off, and now run with it as we've started to do.
Yeah, I guess a lot of investors also felt the same way. But yeah, moving on to the next question. Are there any plans to raise additional capital, either through equity or debt, to fund future expansion? If so, how do you plan to mitigate dilution or increase financial risk?
Yeah, so I would say, so yeah, I'm very very mindful of you know not just dilution but capital allocation and what we get for what we're using. And so I would say when it comes to how we think about things, kind of first and foremost, our internal hurdles for projects are candidly pretty high. I get really excited when there's very fast paybacks to investments. Like the internal saying that we use quite a bit is there should be a path for a 1 year payback, a plan for two, and if it's over two, uh, let's talk about it, right? And so when you look at kind of what we're doing, that's how we think about things. Um, we do that because primarily for us, when we are building or buying pro centers, we call them pro centers, and so that's how we are configuring them. It's heavy on the asset side. Like majority
Mhm.
is inventory. It's inventory that we value. We assess. Very little on the intangibles, on the tangible side. So intuitively, if you have that type of expense, whether you're building or buying, it's mostly going to it's pretty easy to cover with the debt facility, which has been an important part and milestone we announced here a little while back, as a good kind of first stepping stone. When I look at dilution, like, look, you have to get something for it. And so, an area that we're very mindful of is making sure it's accretive, and not just accretive, like, at least my personal perspective, it has to just be an absolute slam dunk, in order for that to make sense. And so I would say for folks who are curious how we'll use debt and equity. I mean, effectively, our growth strategy is primarily one that's going to be on the inventory and other asset side. So intuitively, that's something that you can do with debt. And then from an equity perspective, you want to make sure you don't get up too far over your skis on the balance sheet. And so that's how you use equity, but you do it in a way that's obviously, at least in my opinion, and to us, accretive, very accretive. I think we're in the right environment to be able to do that. This is not a play that requires or a plan that requires lots of R&D or things to align or patents to be approved. This is a
Mm.
very straightforward, hopefully highly accretive consolidation play in a space that myself and the team know very well.
Okay, okay, perfect. So maybe we can dive a bit more onto the pro centers topic. And BuildDirect strategy revolves around consolidating the North American flooring market through pro centers and leveraging e-commerce. Can you break down these two components, how these two components work together? For example, how the pro centers contribute to customer acquisition, and how does e-commerce complement this?
Yeah, and I'll use a very practical example, for this. So in Southern California, about a year and a half ago, we wanted to focus on that market to either build or buy our first pro center. We have a lot of customers, intuitively in Southern California, good area. And so we first off, focused our e-commerce business, doing outside fulfillment in that market, and grew a pretty healthy base of business. And when it got to the right level for our internal metrics, we then pulled the trigger and began shopping for either a build or buy scenario. In that market, it made more sense to build. It was a it was a very black and white decision in that market, and so we opened up our location in Santa Fe Springs. That location today, there are pros who are walking in locally who are shopping along with other segments, but that facility also does now local order fulfillment for Southern California and also some adjacent markets like Arizona and Northern California, so on and so forth. And so that's how our two uh, you know you know main parts that work together. So the way we kind of look at it is e-commerce first in a market,
Mhm.
and then from there, once you have that part um, seeded, then you drop in with either a build or a buy scenario. And so for us, we have many markets where we've been doing that over the last year and a half, and getting volumes to a point where if we were to drop in a brick and mortar location, the cost to operate and or to ramp up is remarkably lower. It's a fantastic flywheel where you can see the market. The alternative to that is you start off with brick and mortar. Uh, over years, you kind of build up a location. Maybe along the way, you have an online business that's maybe profitable, maybe not profitable, just part of the deal. But we use e-commerce very strategically to seed markets, and then from there to drive traffic, and then we move on into the to the next one. So that's how, like, really simply stated, those two things work together.
Mm. Okay, okay, got it. So, BuildDirect has been investing in pro centers and growth initiatives. How do you prioritize capital allocation between organic growth, acquisitions, and operational improvements? And what metrics guide those decisions? I guess you already touched a bit on this, but maybe you could go a bit deeper.
Yeah, I would say on the operational improvement side, there's very little we've done that requires fresh capital. Like when it comes to improvements we made with our systems, there's more to make there over time. For the most part, they've been cost reductions. Yeah, there's very little. There's very little. Like, for example, we're not the type of team to come and say, "Hey, look, for $1 million investment, we could put in place a new CRM. I won't name any, just out of conform. And with that, we'll have, Y improvement on conversion. That's not our team. Our team, um, uh, is very, very focused on practical improvements. We use, for the most part, um, off-the-shelf software. We were early AI adopters internally, very early, very efficient when it comes to tools. And yeah, I think some of that comes from just past experience, scars along the way, so on and so forth. And my personal belief is operational improvements. Uh, yeah, when I talk about payback, it's not on those investments. I mean, I'm not trying to be funny, but like, hours, days, and weeks are better a better like
Yeah.
measurement tool for things like that. When it comes to everything else, and so uh, you know, our, our our intent is to focus our capital on the pro center expansion. And so what that looks like is just literally new locations on build and buy, and it comes down to math. And so um, when we look at potentially buying something, we tend to like our brand better, we like our systems better, we like our inventory profile better, um, and we like to hire and really maintain our culture. So we start there. So in the market, first and foremost, like plan A would be to build, but in this space, very often you find very financially attractive targets, like the one we recently announced, for example, and it's not a one-off, where it makes a lot of sense because you can buy and then convert. Um, uh, and have kind of the best of both worlds. So it puts us in a really interesting spot for uh, uh, building versus buying. And I think which we'll get into, maybe we'll get into it later. But when it comes to like market dynamics and macro factors that could make that math make even more sense. But that's effectively how we focus. And anything else that we do, like a service or this, that, and the other is very much deprioritized because our intent is to dramatically increase our pro center footprint. And so with that, you really need to be focused on just that. And the build versus buy just comes down, as I mentioned before, to the math.
Mhm. Okay, so since we talked so much about pro centers, maybe there are some people listening that don't exactly know what it is. So maybe you could just explain it very quickly so everyone is on the same page.
Yeah, sure. So I'm gonna go into a bit of a backstory that I don't really talk about
Mm.
very much,
Yeah.
but so in my early 20s, uh, this is before like the housing collapse, um,
Yeah.
and I had a lot of fun. Back then I was involved with a few things. I was building spec homes, so building homes before they were sold. Like you're speculating they would sell. Literally very unexperienced. So I had a great partner who was a general contractor who was walking me through it and turned the keys over. And I could have been more than 25 back then. In hindsight, it's a bit of a reckless thing to do, but it was interesting. Like back then, when you needed windows or lumber or insert other, I mean, even shipments of nails, you didn't go to Home Depot or Lowe's. You ordered from the supply shops, and you ordered from them for a very specific reason. Like if you had your copper delivered, for plumbing a day too soon, it would be gone. It would be
Mm.
gone. Like you don't have full-time security hanging out at construction sites, right? And so the realization that there's a very different segment between who the homeowner shops or when the pro needs one window versus 30 was kind of like cemented there. Years later, I'm skipping a lot in between. I was at Home Depot as a merchant, and it was interesting. We talked a lot about the pro customer and wanting to increase our penetration of the pro customer, but man, it was so hard because our stores were set up for the retail customer, and pros could shop in there, but it was for a pro who was shopping like a homeowner. They couldn't back up their truck and have the rolls delivered. It wouldn't be like a 5 minute turnaround. They couldn't pre-order. We didn't do a whole lot for them besides, trying to offer, pro discounts. Wasn't really a good fit. And when you look at the flooring industry, it's not that unique from other industries. Like for roofing, ABC Supply is another beautiful example for roofing. It's a huge roofing company, a huge supplier that most people never heard of, and they do billions, and they're just geared for the pro. And so for me, the realization that professional customers, they want to shop like professional customers, and a big part of that is the type of real estate um, you're putting your operations in really need to be conducive for quick loadout, light industrial, and then on top of that, they tend to not need massive assortments because the pro very often is the one installing the product. And think about
Mm.
that. If you're a pro and you're selling and you're installing your own projects kind of day in and day out, you ideally want like continuity. You don't want every
Mm.
day to pop the box open and then have to relearn the idiosyncrasies of that specific manufacturer. So the idea that you need, more focused, pro oriented assortment, like install friendly assortment, but then have it very, very deep. Because the other thing I learned along the way is look, for a pro, they might need 0 square footage of a SKU today, and they might need 4,000 feet tomorrow. And then on average, like the average homeowner in the industry for their project is only ordering about 650 feet. And so all the retailers, big and small, really orient their stocking position like that. So more broad and less deep. And the supply shop is the literal opposite. It's
Mm.
the core inventory they need, but extremely deep, um, with a lot of expert customer service helping to solve problems like they run into during the install experience. So it's interesting for me. Like a lot of these companies have been very successful with really catering to the homeowner. Like they help them with style and design, so on and so forth. That's not the challenges the pros have. The pros have challenges around needing fast loadout, needing job site delivery the day of, um, not the day before, not the day after, and also help on the installation side as well along the way. So um, that's really for me what got me excited about uh, uh, that segment of customer. So fantastic customer. And then the last thing I would say is I don't like concentration.
Mm.
Don't like
Mm.
businesses that are overly dependent on one specific customer segment, like, you know, new build construction. Um, or commercial renovation, or discretionary consumer spending. We've all kind of seen that play before. So I like the pro customer and the pro center because effectively day in and day out, as customer segments change, as the cycles kind of ebb and flow, that pro adapts. So look, they might be installing in a shopping mall tomorrow. It might be installing in someone's home the next day. It might be part of a project for a larger commercial installation. And so for me, it's a great kind of segment to serve.
Mm. Okay, perfect. Actually, the next question was on how do you differentiate from Home Depot and Lowe's and all that. But I'll tweak it a bit, and I'm actually curious on, like, if you're a pro customer, why do you choose to go to BuildDirect instead of some other pro center? Um, yeah, in the market, because I guess there's not so much branding power in flooring or or something like that. So it would be interesting to know more about that.
Yeah, I mean, really simply stated, um, so for us, we build a shopping experience that's designed for a pro. Now, do homeowners sometimes use it as well? Sure, we have our website online, and if someone's working with the pro, they can buy, or the pro buys, through them. Sorry, for them. But I would say, just really simply stated, and this goes to really all supply shops across North America, regardless of the category they're in. Um, if you're a pro and you need a door handle, then or five for a project, great. You can go to Depot. I'm a huge fan of Depot, and pick those up. That's not us. When you need 30 or 40 of them, you run into some problems pretty fast. On flooring, for example, I mentioned that if the average project is 650 feet and the store is carrying on average 1.5 to 2 times the average project, then you can't just run to different stores to like get what you need, because our average job size is much bigger, as it is most companies who focus on the pro segment, because you have things like dye lot, where you have the same SKU, same color produced at a slightly different time, and they don't line up exactly, and so you have a lot of challenges kind of around that. You also, if you just practically speaking, you can't call a big box store 5 minutes in advance and say, "Hey, look, I need," or even an hour in advance, even the day in advance, and say, "I need X, Y, and Z. Can you have it pre-cut, loaded, and on the dock for me? I'm going to swing by, pick it up, and take off." It's not a thing
Mhm.
at all. Then on top of that, there's a lot of services that are very sticky. So, for example, our pros really view our pro centers, and as we really want them to, as their place. It's their office, it's their showroom, it's where they bring their customers, or they send their customers in a safe environment where we can help them finalize selection. So there's a lot of services that we do, and others who are focused on the pro and other categories, that create an incredible amount of stickiness, which gets back to the build versus buy. So when we find good opportunities in the market where they've really developed that brand, and that stickiness with their pro customers, fantastic, great people. We love adding great people to the team who are like-minded, and that's a pretty important part. I would say when you look at someone like us, we don't view big box retail. I won't get into too many details, but we don't view big box retail as a competitor, like in our value chain. But we're actually, I'll just say, a potential customer. It's not,
Mm.
as far as where we sit, um,
Okay.
in like in the supply chain.
Got it. So then the obvious next question is, who are your actual competitors? Like, other pro centers? Are there other consolidators in the market? Because I'm trying to really figure out what's your competitive advantage, besides like scale and probably being able to source at lower prices and sell cheaper, pass those savings to customers.
Yeah, so for us, the competitive advantage in every town, you have you might not use the word pro center, but you have wholesale shops who sell flooring, and so
Mm,
our average competition is a local retailer who's doing, let's say 5 to sometimes 10 million uh, in volume. For the most part, like using 6.5 million per location is a good kind of average. And so if someone's, has a business that's doing around 20 million, they probably have three and a half locations.
mm.
Um, sorry, you can't have half location, 3 to 4 locations. And so it's a kind of first and foremost, I mean, that's what it is. That's who our competition is. And it's interesting, like there was a roll up done in the software space for flooring, and in a lot of other categories, it would have seemed like their competitive advantage um, was not massive, but within the flooring industry, it sure was. It does very, very well. Did very, very well. And so look at us kind of the same way. We're a bit odd, a bit unique for the team and model we've put together in this industry for sure. And when it comes to competition, that's who we're competing with. What's interesting about that is who we're competing with in some cases, we may also be supplying to. So I go back
Mm,
to what kind of
mm, okay.
where we sit in the value chain. And so we actually might enter a market. Um, we might enter a market becoming a supplier for potential future build and buy. And so it makes us
Okay.
a very unique contender in the space by far.
Yeah, right. And you also have more visibility into how is that business actually doing, right? Because if you're a provider, then you know more. But um, you mentioned software for flooring before, or did I listen wrong?
Yeah, so the example I was giving when you asked about competitive advantages
Uh,
was referencing um, a consolidation play for software within the flooring industry, like on the CRM, ERP
oh,
side.
okay, got it. Okay, I
Yeah,
thought like software for flooring, and I was thinking like, what software does flooring need?
yeah,
And
right. Yeah,
yeah,
it changes
but
temperature. It's great, right? No,
yeah,
yeah. So I would say, like for me personally, like what one thing that I really um, like, look, like the the me 15 years ago had a very different like perspective on I think on innovation and growing companies in a very like a creative way. It was always about, hey, what's that one idea, can it be patented? I've left that naive thinking long ago, and instead really look at, okay, it's about growing a great company that's huge and doing it in a very capital, smart way to where it's highly accretive, and that's what gets me excited. And then doing it in a way that obviously is sticky, defensive, and you do things like that through like avoiding concentration. So, for example, if you're doing an acquisition and you're valuing anything that's intangible and is tied to any kind of heavy concentration, it's marked off the list.
mm,
Customer is doing 15-20% of your volume, mark off the list because things change. And
mm,
that's really where where personally, where my focus lies. I'm very, very much a value investor, um, very much a value investor, and then, build companies that way as well. That makes sense, which is really unpopular in some circles, right?
yeah,
Like it's all about like the next patent or the next thing that you can do X, Y, and Z. Not my mindset. Not what gets me excited. What I get excited about is how can you make an investment and have incredibly lucrative paybacks on how you've structured the deal, and staying rifle focused on what you're doing day in, day out, not chasing a soccer ball around a field or getting distracted by pet projects or things like that. Just see a lot of capital destroyed over what could be fantastic businesses getting very distracted. And we fight very hard to maintain that focus. We have uh, 10 locations today. I'd be thrilled if we had 75 and we got there in a very capital smart way. This business, in my opinion, could be very easily $500 million in revenue without having to enter into tertiary markets. And so for us, it's not a matter of growth or ideas for growth. It's just staying focused so that as we are growing, we do it in a way that's very accretive.
Mm, got it. Actually, it's funny because when you were talking, I was reminded of this story. I'm actually helping organize this value investing conference here in Portugal, and you have loads of some of the best investors. And I was talking about this conference with a friend, and he was saying like, it lacks a bit of AI, and I was like, what? What is this? It's value investing. It's not AI, but anyways, I resonate with what you said, and actually talking on like market and growth and all that. So you mentioned like the flooring market is 90 billion,
Mhm,
with adjacent markets representing around 200 billion. That's not what you said, but that's what I'm reading in the question.
mhm.
So what's your strategy for expanding into those adjacent markets, and how will you prioritize those opportunities first? Because I guess diversification is also one of your key pillars. So maybe, yeah, you could dive a bit more in that.
Yeah, so I'm going to touch a bit on why I like the flooring industry specifically, and then I'm going to talk
Mhm.
about the adjacent categories because those two things actually go hand in hand. Um,
Sounds good.
so first, and I've lived through these cycles, and I remember I was at the office like at 8 or so at night when the financial collapse, the first one of my career, happened, and I was asked a question like, I was the product director for a pretty large category, and how are we going to layer in the impacts of the banks collapsing? I'm sitting there just like, hey, look, if I could do that, I wouldn't be here, right? That's
Yeah.
not. I mean, this is a pretty crazy scenario. But with that said, it didn't like stop the industry. The flooring industry is interesting. It's a category that you live on, so it has wear and tear. It's also a fashion category, so as quality is improved, style and design still drives change, and
Mm,
it's not overly dependent on like new construction cycles. So
mhm,
all the things back to value investing that I like
mm,
diversification. I've lived through some pretty interesting times in that space, and you can see it in the industry numbers for sure. So, like for example, around 65% in our view of all flooring is driven from remodeling projects. So
okay.
when housing turnovers, when new construction slows down, people renovate their existing spaces. When they pick up, then you have that pickup as well. A lot of the adjacent categories, like for example, cabinetry is a natural fit, not custom, but uh, your basic assortment, like RT, like you have categories like that, countertops, trim, molding, other items inside the home that our current customer services. And so, first and foremost, what drives categories that we're interested in is who our existing customer, other categories that they're in, first and foremost, because that helps improve stickiness. And obviously, it's a lot less expensive to get into a category and to grow it. BuildDirect was in many of these categories years ago, before really our current leadership team came on board, and it was interesting going back to what we used to do in those categories, how they were modeled, and a lot of that has improved, simplified. Our suppliers, you have a lot of crossover. For example, flooring suppliers who also are in those spaces. And so I would say first and foremost, we're interested in serving our existing customers better through product expansion, not going after brand new customer segments. Now, as far as how we get into those categories, I'll give you a few examples. So for the
mhm,
most part, we're not in the tile business, and
mhm.
tiles is huge. 35% of the flooring industry. Some estimates have. We have huge tile showrooms with lots of selection. It's not our deal. We have a core assortment that is suited for the pro customer. Sure, it's a possibility. How do we get into that net new segment or product segment? Well, I mentioned before, we start online, which if you go online, you can find tiles been added recently, and then from there
Mm,
we learn, and it shows up in our brick and mortar. So on categories like that, which there are a few of them, it makes a lot of sense just rolling into it as we kind of as we go, very low cost. It's more about refining the assortment. When it comes to things more that are a little more complex, like for example, countertops, cabinets, like that's a good example. More than likely, that would probably be an artifact of or an entry point rather from an acquisition, because as we buy businesses, they don't all just do flooring. And so when
mm,
you're looking at targets or our pipeline, many cases it's flooring plus one, and that plus one is interesting in some cases. And so I would say that's how we think about those two things. Those categories, though, are heavily impacted by building cycles. And so,
mm,
personally, I believe the base business needs to be flooring. Flooring drives a ton of the remodeling work in bad times, and then layering on responsibly a few other categories that can be great, but also can be susceptible to building cycles is just something that we're very mindful of.
mm. Okay. So can you just dive a bit deeper on why flooring is more defensive? I understood the part of 65% is driven by renovation, but I'm not an expert on the construction industry. My dad is actually a civil engineer, but that's as much as I know. So maybe you could, yeah, explain a bit better why is that the case and not with other categories.
Yeah, so simply stated, uh, to get your occupancy permit, you have to have flooring in
Mm,
a in a space, right? Like
mm,
there was a like I don't want to say fad, but just like a new category where you like stain concrete that kind of came
mm,
and went. Not great experience. But like you have to have flooring to have occupancy. So that's one like fact, right? So as long as we're all living inside and working inside in some regard, even now outside, it seems like you need to have flooring first and foremost. The second thing is, I mean, what else in a building do you literally walk on all day? Uh, I mean, it's constantly like by design exposed to wear and tear. So
mm,
you have that, and then third, because it's effectively the largest piece of furniture or decor in the space, it's very susceptible to design trends. Good and bad, right? Like so, you know, um, uh, you have really those three main things, and that's really hard to say about really anything else. And so for the flooring industry. Here again, when it comes to new construction, they all have flooring, and when it comes to just day in day out renovation, it's a huge category for people to improve their living spaces. And it's so effectively a required material that's heavily goes through wear and tear, and also has style and design. Really hitting it. The average lifespan of flooring, flooring very often, the saying is it uglies out before it wears out.
mm,
And so that for me is really important. It's inexpensive, like relative to other things you can do, like replacing cabinets in your house. If you are remodeling a kitchen, for example, is very expensive. That's why the refacing
really?
industry has done very well, or just painting has done very well. You can't reface flooring. You have to replace
Mm,
it, and it's very inexpensive, relatively speaking. So it's
mm,
a category where you can make a huge improvement to your space. It's also very narrative driven. And so creating brands that really fit specific segments is, so A, it's a lot of fun. And then B, it's a great way of tailoring your assortment to a particular segment. And so for all those reasons, my opinion, it's if you want access to or exposure rather to that market when it comes to building, construction, renovation. It's a good entry point to that if you're choosing a category like that that's not nearly as uh, cyclical in nature.
mm. Okay, yeah, that makes a ton of sense. Actually, it's like Yeah, low switching like, I mean, it's very cheap. And actually, I was thinking about when we did renovation here in the house, flooring was one of the first things that came to mind, because yeah, you're just exposed to it every day and you look at it
Mhm.
and it's like ugly and right, and so you want to change it. So yeah, makes sense. Now, I'm really sorry if I have to ask this question, but everyone wants to know, how are you adapting to the tariffs?
Yeah, no, so it's a fair question. So I mean, first and foremost, we have a pretty experienced team, and so as we're working through kind of how to handle this, we're taking it, I think, at the right pace. And so when you're managing tariffs or changes like this, there's a few things you have to keep in mind. You have to be mindful of any kind of changes to cash cycles. What actually is qualified, because headline tariffs don't actually map out to what specific product categories are like that tied to construction. And
Mm,
so a lot of that information still coming out, being kind of finalized. We are in a good spot when it comes to we do have a bit of scale in the industry, so we're not in like a defenseless position. We can leverage a few different ways to help offset. So at this point, what we're doing is being patient, being mindful of what the impacts could be, and also not putting in place a knee-jerk reaction. I would say at a very basic level, so most of the carpet that's consumed in North America is made in North America, and carpet's a pretty big
mm,
category for us. Most of the hard surface is not, and importing, even with really high tariffs, is still a lot less expensive than domestic manufacturing, which is
okay.
something that I won't get into the rabbit trail on this one, but inexpensive energy is a huge component for a lot of manufacturing, and it's very difficult to replicate. So for us, that's how we're approaching it. And I would say we are not tied to long-term supply contracts. I mentioned a few times I don't like concentration. Um, and so I do think we're going to be in a good spot there where we can be nimble, move around, um, to be in the best position that we potentially could be in. Macro impacts, we'll see. Like for example, when the rates froze up and got to where it made home buying very difficult in a lot of areas. We saw our new construction driven segment a bit softer, but other segments a bit better. So
Mm,
from my perspective, it's more about being mindful of things like that happening. More macro on the recessionary perspective. Forefront than specifically like trying to work around a X number of year supply agreement we have with Y manufacturer. We don't operate that way. We don't tie ourselves down um, to any specific group there. We're very nimble.
okay. Yeah, so I guess you're also, it's also easy to pass on the cost increases to customers, because at the end of the day, everyone will have higher prices when sourcing. So
Mhm.
yeah, it's not just you. Okay, so last question from the audience, and then I have to jump to my questions. So how big is your acquisition pipeline, and can we expect transactions in 2025?
So I would say it's big enough that we we have our pick of what we want to do, and it comes back down to the same model before: e-commerce first, where it makes sense, and then where we want to buy. But it has to make sense. And so I would say, like I've said a few times, we have 10 locations today. Want to have 75. Want to get there in a very creative and capital efficient way. So should you expect more? Sure. Uh, when it comes to what those looks like as far as deal structures, I've been pretty open with. We're very much like tangible asset focused, and there's not a shortage of targets out there that that'd be a great fit, but it's just prioritizing, making sure the ones we do work well, integrate well, and continue to build on that on that foundation. Um, so yeah, I would say, ideally, like what you're looking at from us is, like from a milestone perspective, should be a relatively straightforward deal where we're talking about announcing a new location was built or a new location was bought. And in some cases, maybe it was a hybrid of the two. Because on the other side of either one of those, it's the same. For us, it's another pro center or another 3 or 4 pro centers maybe at once.
Mm, got it, got it. Okay, perfect. So, just curious to know what motivates you in your role as CEO, and yeah, how does it feel to be a CEO of a public company?
So it takes a village, right? And that's a kind of a cliche statement, but it really does take a village. And the team we have here has been fantastic. So, like, look, there definitely are considerations and pressures. We have a lot of stakeholders that we work with, whether they be our own team. I definitely believe your customer experience will never exceed your associate, your team member experience, and we try to lead with that in mind. But for me, what gets me excited is like being able to have a very clear vision. Having a team that was very much part of casting that vision and making it a real thing, and then having them really invested for for the build process, and not like we're in this space because we want to be, we really like it,
Mm,
we believe in it, and we have a lot of passion for it. And so with that, sometimes, and I could be guilty of it, you have a lot of weekend ideas on how you can make things better and better, and you have to stay rifle focused on what that core deal is. But I would say that for me is probably the most rewarding rewarding part, and I really believe in a colleague type of mindset,
mhm,
as we're progressing, because you really have to have that nowadays, probably more than ever, to be successful. And we're working with suppliers, potential acquisition targets, and the new associates. That's always a huge part of what as well, right? A company's culture is the aggregate of the individual team members. Uh, Company doesn't have a culture like by itself. It's kind of a weird thought.
yeah,
And so that's something that's definitely top of mind for us.
cool, cool. Okay, so this is a bit of a random question, but I'm curious to know a bit more on your childhood and kind of what got you here. Obviously, we already talked on why you joined BuildDirect and your experience in the flooring industry, but yeah, just curious a bit more on on your childhood and your interests back then.
Yeah. So um, well, my childhood and the flooring industry kind of go hand in hand. I entered the industry when I was 16.
Wow,
It
wow,
was
wow.
yeah, I went to work for like a local flooring retailer. And funny enough, I was like their IT person, right? Because computers were coming out and this thing called
Yeah.
email, so on and so forth. Um, the owner of that business was Jim Simpson. Like, he was a fantastic mentor. Just we had, like, I don't know, probably a 50-year age difference, and just kind of took me under his wings. And he later on was the person I mentioned, was a general contractor that got me into spec building homes, and eventually helped me get placed into Mohawk Industries. That's where I kind of grew up in my 20s. And that company was just a gift, right? Like, did a great job. As a company, but a wonderful job developing its associates, letting us bounce around from marketing to finance to projects to other things, as well as a lot of mentorship and development along the way. So I'd say, like, for me, that's kind of been you know been tightly aligned. But then for me, just personally, I remember one of my earlier memories. You know, like in my early, like mid teenage years. Yeah, I remember sitting on the floor with a classified newspaper, trying to find something I could do before my first job at the flooring store that was meaningful. And just being a bit impatient of wanting to build. I love to build. Building is just a lot of fun, whether it be a house or a business or a team. That for me is what gets me, super excited. It's what I do for fun and a lot of free time. Helping I think others in that regard. Whether so that for me is what gets me really excited, and a lot of those kind of early memories tie kind of tie back. So um,
Mm.
yeah, very random. That was a bit of a random question and kind of a random answer, I think, but it's what comes to mind.
Yeah, no, it's always cool to understand better the backgrounds, and I guess you're the living proof of that saying that you don't choose your passions choose you. And so I think in this case, flooring chose you, and you had no option. So
It's
yeah,
fate. You got it.
yeah. My next question is actually, what's your favorite mistake?
So, uh, my favorite mistake is I have a few to choose from. A while back, we tried as a full install online flooring model, and it was pretty cool. This is back in 2020, and the business was My Flooring. And I won't get too far in the weeds, but we effectively used someone's home address to predict the dimensions of their rooms to allow them to buy flooring by the room, and it was fully installed. And like, with AI today, you'd be able to fit that model, remarkably better. And the feedback from the customers, effectively, like we had to we had to add sub processes to make it seem more elaborate. We didn't need them, but
Yeah.
literally the feedback over and over again was this is not like a thing. It's not
Uh-huh.
there has to be something, off with it. And so the realization that um, you have to put more meat on the bone, even if you don't need it on the experience side was, A, is very expensive, lesson in a few different ways, but that probably like really stuck with me, for sure as, like the root of the error was thinking that the world is completely economically like it wants to be totally efficient, um and it's not, right? Like it comes down to a consumer, their experience, how they're feeling about a situation, and really bringing them along. One area of my career, that I consistently got feedback from mentors on was making sure I slow down to bring people along. Um, and that's just a reminder of it takes a village, and you have to make sure even a customer you're bringing along on the journey, you can't just give them the exact answer for what they need. Um, the last one I'll give, this is actually like a test from a long time ago, a lot at Home Depot, where back in the same vein, I was convinced that people just wanted to find the type of flooring they wanted instantaneously. So we set up cameras in the stores, and then we just got rid of all branding, all narrative, all messaging, and had like laminate, wood, carpet. Like it was just very black and white on the
Mhm.
categories. This is a long time ago. This happened. Um, and in the video, yeah, use video. You can't just use AI. It showed that people would find what they wanted fast. Like they spent less time in the showroom before taking a sample, and sales were just terrible, terrible. And I got the biggest "I told you so" from a mentor. And that was actually, funny enough, the spawn, at least for me personally, of then developing the LifeProof brand, which is still at Depot today. It's one of their biggest brands. And it was like the far extreme. Like, okay, you want a narrative? Here's a narrative. Here's a brand. Just a realization that like categories like this, it's not about being perfectly efficient. Like you have to bring the
Yeah.
customer along for the journey. If that makes sense.
Mhm. Cool. Yeah, actually, that's a funny one. And if you had asked me before, like telling me the result, I would also probably have thought as you did back then. So, uh, yeah. Okay, so I have three last questions, and maybe then we can wrap up. You can answer them simply or expand whatever you want. So the first one is, what do you fear?
I would say, yeah, I would say for for the most part, just blind spots,
Hmm.
personally or professionally. And so I tried to surround myself and ask for feedback. But yeah, it's the blind spots that will get you.
Mm, cool. Then also, I guess you already talked a bit about this, but what do you enjoy doing outside of work?
Yeah, so I have four kids, which has
Wow.
been a huge blessing. And we had kids, fairly young, which has been great. Well, it's good and bad. Like, so we had them young enough to where, you know, at this point, like, we did a mud run on Saturday, a tough mudder. So
Yeah.
I really enjoyed spending time with them. However, I thought it was a 5K, not a 15K. And I'm like watching my 16-year-old son who's flying through, uh, the like the obstacle at the very end that has like the electrical shock cords, which
Yeah.
I mean it's difficult. Like when your son's flying through. My other son, who's a bit younger, he already went through it a half hour ago. Like he was way ahead of us, and so like for me, I really enjoy um the time we get to spend, and it's been a huge blessing. Never want to do that again. It was not
Yeah.
not a fun experience, but for us, like we enjoy the outdoors, and a few different activities kind of in that regard, whether it be off-roading or golf or kind of things like that. We're definitely outdoor people, and it's been a pretty big part of our life, kind of along the way. We are a bit unusual though. My wife and I, we really include our kids in our life along the way. Partly because you kind of have to, and then the other part is making space as well. So it's been a pretty big part for us.
Do you take your kids to the office? Because I remember back when my dad was like an executive at this engineering firm, he would take me to the office, and it was really great. It was super cool.
Yeah, I would say so not so much to the office, actively involved in conversations, 100%. And so like for us, we believe even at young ages are they're capable of a lot of understanding, and really just kind of spending time with them and having those adult conversations. And so if you were to plug one of them on the call today, it might be surprising how much they know, understand, point of view,
Hmm.
and the types of conversations that we have. Yeah, definitely a huge thing. I think out of the four kids, might end up with one or two entrepreneurs. We'll see. But more importantly, what's been great for me is they all have had pretty good experience, meeting people, interacting, and getting a view. I think that helps, really create more open-minded people, and also
Hmm.
opportunities in the future. So.
Hmm. Cool, awesome. Okay, the last one is very very concise. How often do you check the company's stock price?
So often, I'll say often enough. So probably every like 2 or 3 days, I'll see it. It's pretty far down on my stocks list. And so like, but I might have a different view. Like, look, it's a public company. We're subject to blackouts. I place uh, a much higher intrinsic value because I get what these things are worth, and I find myself often. Yeah, it's it's not something that, like, how do I say this the right way, that makes me feel good or bad, but it's more about like, it's more about, for the most part, making sure that we're conveying with complete accuracy what we're doing, and then following through with our plans and having strong connectivity there. So one thing I'm very sensitive to when you bring along investors, like they're putting their faith and trust that you have expertise, you're doing what you say you're going to do, so on and so forth. So yeah, I would say not obsessively. It always is fun to see what's out there, what news is, so on and so forth. But um, yeah, it's effectively it. We have a very very tight float. We have
Mhm.
fantastic insiders. There's not a lot of free trading stock out there, so it's yeah, not no not a lot of you know distraction for sure.
Cool. Actually, you're the CEO that checks the least the stock price that I've met. Uh, yeah,
Whoops.
usually. No. Actually, I think that's a good thing. Most people tell me either way too often or like twice a day or every hour or something like that. So I guess that's interesting. And I think like I don't know if it was Warren Buffett or someone like that actually said they almost never check the stock price. But yeah, I guess it really depends also on your personality. But that was a good question to wrap up with, and just wanted to thank you for this hour that you gifted us, and yeah, happy to chat anytime if you have any updates.
Yeah, sounds great. Thank you for your time. Appreciate it very much.